Well, that's one of the points that worries me about the price action. I guess the second point is that a few of the cyclical sectors in the US are still behaving quite weak, and the obvious one was retail last week, which, whether you look at it from an outright perspective or relative to the S&P 500, broke down technically, which was a little bit bearish. Obviously, the retailers, their forward guidance was very, very poor, but that and cyclicals versus defensive sectors more broadly is still behaving in a fairly bearish fashion, consistent with the Treasury yield not rising, even though we've seen some cyclical improvement in the macro news flow.
It's a bit of a conundrum, isn't it? The
Yes.
US consumer, two-thirds of the broader economy, they should be firing on all four cylinders, given the windfall from the oil price crash. Why isn't that happening?
It's a really good question, and I don't think anyone's got a great answer for it.
Is it the debt? Is it the leverage? Are they using those savings from energy to pay down their debt?
I think that's plausible. I think the savings rate has gone up, or is still relatively elevated, so that's probably part of the answer. I'm not sure whether we're necessarily counting retail sales very well either in sort of the new regime, and certainly Amazon is stealing market share from the traditional retailers, so that's probably part of the answer as well.
If you put it all together, is there a non-negligible risk that the Fed hikes in June, despite Brexit, despite international developments, etc., or are they afraid of the markets and the markets throwing a tantrum if they do?
Well, my working assumption in the post-crisis regime is to never underestimate the Fed's ability to outdove the market. And I think that's probably still true, but there's certainly been an improvement in inflation expectations and actual core inflation, at least on that side of their mandate. But the way I observe the macro news flow is that it's still been relatively disappointing. So June is probably a line ball, and I'm not convinced they're actually going to hike at all this year.
How close do you think the Fed are watching China? And specifically, when you look at the weekend's data, was pretty soggy. Does it change the way that you approach the mainland markets? Do you approach them still with a healthy dose of caution?
There's a couple of points on China. I think, one, we have seen a genuine improvement since this time last year, so the macro news flow has definitely improved.
But it's tentative stabilisation, though, isn't it?
Yeah, look, I mean, it's definitely been driven by policy easing, both on the credit side, on the monetary side, and we've seen it on the fiscal side, I think, in China as well. And then that's evident in the property price appreciation, which is why I think there was potentially last week a policy tilt, sort of away from growth support back towards reform, potentially. But at least it's we've seen a stabilisation. But it's certainly worrying the way the local share market's reacting to news again. The dollar CNY appears to be getting some strength again a little bit in the short term.
Tactically, then, if you put it all together, should you remain cautious on the China equity story? Because we continue to see arguably mixed policy signals. We've got this bad debt situation and earnings have continued to disappoint.
Yeah, I'm more worried about the markets that are levered to China than China specifically. The Chinese equity market is at such a deep discount in terms of valuation, and people, I think, are reasonably pessimistic. I think where people have probably been too optimistic, at least in the short term, not necessarily in a medium-term basis, but in the short term, is on the commodity-related markets, and we've already seen iron ore and steel roll over again and those sorts of markets. So I'm more concerned about markets levered to China than China specifically.
Yeah,